The coronavirus is having a major impact on bond rates, with the 10-year Treasury note hitting record lows as investors flee to safety. And that's good news for those who want to borrow, not so much for those of us who are trying to save. Zachary Griffiths is a rate strategist at Wells Fargo. He's joining us from Charlotte. Good morning to you. What is the chance we're going to see a drop here to 1% or lower on the 10-year?
So we think there's a chance of that, and it's hard to say what the next development is going to be with the coronavirus. What we've been looking at is Fed funds futures and what they imply for year end. To get to 1% on the 10-year, we think you need to see implied Fed funds at 0.5%. We're closer to 0.8, 0.85 this morning, so got a ways to go. But as far as the impact the coronavirus is having, if you have another big outbreak in a major economy, I think that move is definitely possible.
Zach, yesterday we talked to Mohammed Al-Arian. I asked him, what is the market pricing in? He said it is not yet pricing in a recession, but is the bond market right now pricing in somewhat of a mild recession later this year for the U.S.?
Yeah, I think what you're seeing is the market is pricing in some longer-term economic concerns, not just fears related to the coronavirus, where you say, let me get out of equities and into bonds as there's this headline risk. I think you are starting to see some of these broader, longer-term fears. And I think at this point, as far as the U.S. economy is concerned, some of those fears are overblown. And until we see some hard data, I think this move is at least a little bit overdone at this point.
You know, Zachary, if you look at the Fed funds rate, it looks like investors are banking on an interest rate cut from the Federal Reserve, most likely at its March 18th meeting, if not before, in the form of perhaps an emergency rate cut. Do you think that investors are setting themselves up for disappointment?
I do, because I don't think that an emergency cut is on the table at this point, and I also don't think that it would have the intended consequences of calming market fears. If you go back to January of 2008, the Fed did an emergency cut back then, and they cut 75 basis points. The market reaction was not great. It was mixed at best, and granted that was during the global financial crisis, which was a very extreme time, but I don't think that it would instill confidence that the Fed is going to act preemptively. I think that would instill more fear.
Zach, what happens if the Fed looks like they come out and they do cut rates in March? What happens to the 10-year?
I don't think a whole lot happens at this point, because that really is priced into the market. And as far as we're concerned, the house view at Wells is still that the Fed remains on hold, but obviously literally over the past week, 24 hours, that's all been shifting. Obviously that's very offsides with what the market is pricing. I think a thing that we've been thinking about is going back to 2019. The Fed has shown they're very willing to act preemptively when we have this type of uncertainty, and there's been plenty of work done saying that when there's little monetary policy ammunition left, it's better to use it sooner than to let the situation deteriorate too much.
All right, Zachary Griffiths of Wells Fargo, thanks so much for being with us this morning.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.